Thank you, David. We'll commence our Library Commission Finance Committee meeting for this afternoon. We'll start off with should start off with our call to order. Let's do that. So Commissioner Elkind.
Here.
Commissioner Doyle.
Here.
Commissioner Kale.
Here.
And I am here also, so we have a full house. Any announcements? Hearing none. Public appearances. Anyone in the public out there?
There are no members of the public in attendance and no members of the public submitted comments.
Thank you very much. Okay, we'll move right into 4.1 budget, accounting and finance services workflow. And Mary, would you like to lead us through that?
Sure. The workflow has not changed. And it has. To allow for more substantive discussion and allow proper discussion for these important items that are on the agenda today. With having said that, in December, you will have on the agenda the policy for allocation and appropriations of fiscal surplus. And then in January, we'll see the second update for capital projects. And then mid-year in February. Right now we do. So no other changes today, just looking forward to the budget workshop in April, on April 16th. And we'll be kicking off the budget process pretty soon.
Thanks very much. So for our December meeting, all we have are like our normal financial reports and this one discussion about the policy for allocation.
At this time, that's correct. The workflow, really, the purpose of it was to identify major items for discussion and decisions.
Thanks very much, and thanks for your thoughtful decision to put that off. It would have been a lot to take on today with our audit, so thank you for that. All righty.
All right, may I ask a question?
Yes.
Myrna, I thought I heard you give a specific date for the budget workshop. What day did you say that's going to be? 16th. That's a Wednesday? Yeah, okay, I see it. Yeah, great. Thank you. Got it. Thank you very much.
Ending June 30th, 2024, and I believe we have our auditor with us. And welcome to our meeting. Thank you for being with us. And, my only preliminary comment would just be, well done staff and well done you. It's great to have this done on a timely basis. Great for their staff to be able to provide you with the information that you needed and for you and your staff to get it done. So we're happy to welcome you. What seems early in only November, so that's great. And
that I just want to say thank you for that. It was we did have a little bit of timing challenges. I was trying to get the draft report to Myrna a little bit sooner, and so we apologize for not giving this committee more time with the draft prior to this meeting.
Well,
Can we turn up the volume and the roll, please?
and maybe you can you turn yours up or?
I don't have any control.
You don't? Okay.
Yeah, sorry, unfortunately. Can you hear me okay?
It's a little fuzzy.
I'm able to hear you pretty well. I'm speaking rather loudly in my office. I'm not sure what other steps we could take.
Well,
Seems like there are none.
Yeah, I'll see what I can do. Okay. Try and speak again, Kellen?
Can you hear me?
Much better, better. It's on our end. Thank you.
thank you,
Great.
Dawn.
I can actually hear you a lot better now too, so that's good.
All right. Well, jump right in. You have the floor.
Absolutely. Can everybody see my screen okay?
Yes.
Yep.
All right. So this is the 2024 audit team. Myself, who you're familiar with, Brett Bradford, who is our engagement quality control reviewer, who you might remember from past engagements. And I wanted to specifically call out Sarah Owen, who is the audit supervisor for this year. Sarah has been working with me specifically on government audits for about 5 years now. She's one of the key members in our government auditing team. She's actually on the Zoom today, but she has been severely under the weather. And so I asked her to leave her camera off unless there's any specific questions directed to her. But I did want to acknowledge her participation and help during the audit. And lastly, Andrew Deering is the associate on the library. Whoop, excuse me. And as you'll probably recall from past years, I always do like to start with this slide, just because it is always important for us to kind of reset what the expectations are between us, the auditors, and management by reviewing the roles and responsibilities. So as we've discussed, management is responsible for all the information within the financial statements. They're responsible for the system of internal controls to ensure the accuracy of the financial statements. They're responsible for all the financial and non-financial information within the financial statements. And our responsibility as the auditor is to express our opinion on whether or not we believe the financial statements are free of material misstatement. And we do that by what's called a risk-based approach, which is the approach that the professional standards dictate that we take. It does not mean that the library is specifically risky. I recently had a client ask me that, so I want to clarify. It's just that that's the approach that the professional standards want us to take, as opposed to the old way of auditing about 15 years ago or so. It was a balance sheet or a statement of net position approach. So the risk-based approach means that we need to consider all the risk factors, such as the inherent risk, which is the underlying complexity within the financial statements. And then we also have to consider the control risk, which is the system of internal controls, staffing experience, the review process, all the controls that go into ensuring the accuracy of the financial statements. Once we have considered all the risks during our planning phase, we then perform a set of procedures based off our risk assessment, and that can include analytical procedures, tests of year imbalances, confirmations, all of the above. Additionally, we also review, read, and scrutinize the financial statement disclosures to make sure that they are materially accurate as well. And so this is just a real brief overview, the highlights for this fiscal year, your deferred total assets and deferred outflows. We've discussed deferred outflows, but I left those slides in again for this year just so that we could refresh ourselves on that. But just the brief way to think of them, they are similar to assets. So that's why we group them together. So total assets and deferred outflows exceed liabilities and deferred inflows by approximately 39 million, an increase of 1.2 million. And then while overall fund balance increased by almost 2 million, the Measure Y fund balance decreased by approximately 1 million, and has an ending fund balance of approximately 21.8 million. And then this is just a real brief overview of where we spend our time. There's other sections that we did not include here, and the percentages are not particularly accurate, but just meant to kind of give you an idea of where we're spending our time. So cash and investments, obviously a very important part of the audit, relatively easy to audit, but we want to make sure that that number is 100% accurate, just because it is so important to any organization. Revenue recognition and accounts receivable, that is a big chunk of the audit, about 15%. And as I previously mentioned, financial statement presentation and disclosure, we spend a lot of time making sure that the financial statements are complete, without bias, that all the required disclosures are there. And even though it's similar financial statements year to year, it is still a very large part of the audit. Accounts payable and other liabilities, that mainly consists of completeness testing. So we want to make sure that all the liabilities that should be recorded in this fiscal year are recorded in the year appropriately. The pension and OPEB that we've talked a lot about in years past, a big part of this audit, making sure that we're reading and understanding the pension and OPEB reports and making sure that all of those disclosures are reported correctly. It's a little bit tricky, so we want to make sure that all that information is reported accurately within the financial statements. The Measure Y compliance, which we're going to talk about a little bit later in the next couple slides, about 15%. And then capital assets and leases, another 10%. And there's about 5 or 10% of other sections that we're not listing here, but these are the main facets of the audit. Okay, so I mentioned deferred inflows and outflows at the beginning. Again, we've talked about this in past years, but it's such a unusual concept that I wanted to make sure that we left this slide in for this year. And right here, I've got the textbook definition of what a deferred outflow is, and it's the current consumption of net assets applicable to future reporting periods. A deferred inflow is the current acquisition of net assets by the government that is applicable to future periods. And really, this is only applicable to the library as it relates to pension and OPEB plans. Full disclosure that I've never actually seen a deferred inflow or deferred outflow that wasn't related to the pension or OPEB plans. Those are the most common types of deferred inflows and outflows. And the library has, I'm on the statement of net position, there's about 7 million and 3 million of deferred outflows related to the pension and OPEB plans for this year. The majority of these amounts relate to contributions made subsequent to the measurement date. So again, the measurement date for these plans takes place in arrears. And so there's contributions that are made, and this is the way the GASB says that we need to account for those by showing them as deferred outflows. For example, contributions made in 2024, but were not included in the actuarial calculations, again, in the past, get reported as deferred outflows. And then deferred inflows, approximately 500,000 and 1.8 million, again, related to the pension and OPEB plans. This is mostly due to differences in the actual versus projected earnings on the investment plans. So again, when these actuarials are doing their calculations, projecting forward, there's obviously going to be differences between what's been projected and the actual results, and that creates this deferred inflow variance. And again, Appendix A for the CalPERS report on on page 22 and 23 of the Foster's report has a complete history and projected and actual earnings creating these deferred inflows. So if you really want to dig in and see the history of what's creating these timing differences and these deferred inflows, you have the reports to do so. All right, the Measure Y compliance. Again, very similar to the past, just wanted to make it clear that, when we're looking at whether or not expenditures are in compliance, we're looking at the Measure Y ballot, and we're also looking at the Library Maintenance Restoration Act ordinance as approved by the commission. And that's really our guiding map for what is an allowable expenditure in accordance with Measure Y. We don't evaluate the effectiveness of Measure Y or the accomplishments of the programs funded by Measure Y. We're really just looking at a black and white yes or no. Were these expenditures allowable in accordance with Measure Y, and not any sort of managerial function of trying to determine if these funds should have been spent in that way. And this is very important to explain to the Measure Y committee, but I also like to just refresh your memory on this as well, so that we're all clear on what exactly our roles are as the auditor. So really, we're auditing compliance of the expenditures, looking for allowability. That's again, whether or not it's an allowable cost. We want to look at the classification, making sure that something's not being misclassified. And again, whether or not it's in the correct period, which we call the cutoff assertion. And then the allowable costs, we're looking at that compared to section C and D of the expenditure plan. This is just some of the items that we deem to be allowable in accordance with the plan. Maintenance, existing libraries, improvements, upgrading facilities, supporting library programs, and improving access to libraries. So as you can see, that's a pretty wide and broad range for what those Measure Y costs are allowable. And again, we're really just making sure that it fits one of these categories and that there's nothing that's not unallowable. So in conclusion, we're about 95 to 99% complete with the audit. We are going to issue a clean audit opinion that the financial statements are free of material misstatement, and that our government auditing compliance report, there will be no reportable instances of non-compliance or material weaknesses in internal control. So again, both clean audit opinions again for 2024. And then lastly, this is a slide that we're required to communicate to those charged with governance. During the audit, we did not encounter any fraud, illegal acts, or significant or unusual transactions, something that maybe we weren't sure how to treat or wasn't unclear of what the purpose was. We did not encounter anything like that. And I always like to caveat that if we did have any of these things, we wouldn't wait until the last minute to let you know about these large issues. And with that, I'm happy to take any questions on our audit, on my presentation, or on the financial statements.
Thank you, Kellen. Nice, clear, and concise overview. I wanted to take the opportunity on our behalf to thank Sarah and hope she gets well soon. I don't know her, but I feel bad for her having to be on this meeting when she's sick. And also, I believe you said Andrew was working on it. So thanks to you and your team. Would either our CFO or our accounting manager like to make any comments before we ask our questions?
No, I just want to recognize the work of our team here at the library, including Catherine Line, our accounting manager, for working through a lot of these details. It's her first audit with the library. And also our accounting partners with the county that help us prepare the financial statements and work with us throughout the year in doing all of our transactions. And I also want to thank Presinti and Brinker for their work and detailed work, as well as any recommendations or suggestions that we can implement going forward. There's always opportunity for excellence, and so we look forward to. I want to thank them for all of their work that they've done, and I'm just pleased that we have this report with a clean audit report, and look forward to continuing the work that we do here at the library to support the library services that we provide to our community.
Thank you.
Thanks for asking. It was really great.
I'm sorry, I missed that. I didn't hear anything. If that was directed at me, I apologize.
No, I was asking Catherine, our county manager, for her comments since it was her first walk through the park with the audit here.
Yes, just working with my team and the accounting team in Myrna and President Beaker was really an honor to work with them. Thank you.
Well, great. Well, congratulations all around. Nothing like clean audit to make us all happy. I have some questions I'd like to ask my colleagues on the committee if they'd like to ask theirs first. Andy?
Thanks, Barbara. Kellen, great to see you again. Thanks so much for leading this effort. I have a few overview questions I wanted to ask. First of all, last year, I recall when we went through this, there were some changes in the law or the GASB requirements that related to, I think it was capitalization of leases or something like that. In going through this, I didn't really notice anything jumping out that seemed like a significant change in the underlying regulations. Was there something I missed, or not really any significant accounting changes required this year?
No, your recollection is spot on. Last year, there was the implementation of what we call a SPIDA, which is a subscription-based IT. It's very similar to a lease. And so that did create some unusual and new accounting and exciting accounting transactions that we needed to account for, which is now you'll see continuing on in these financial statements. But you're correct, there was no significant or new, there's always some new GASBs that are applicable for the year, but they were not applicable to your type of government entity. So there were no material new GASB pronouncements that we implemented this year.
That's great to hear. I think I know the answer to this next question, but I wanted to hear it from you. The fact that we're seeing this preliminary audit in November makes me feel like the process of conducting it went fairly smoothly from your perspective. Was that the case? And if you would just comment on the kind of the quality and cleanliness of the material that you received from the library.
Yeah, I would like to, commend the quality of the information that we got. As I said at the very, very beginning, we were a little bit a day or so late on getting the draft over to Myrna, which was 100% my fault and not anything to do with their team or my team. It was strictly a delay on my end. So other than that, everything went very smoothly. Yes, it took a group effort, I would say, to move up the date, but overall, I was very pleased with the process and very appreciative to everybody at the library and especially at the county for getting us all the information.
I'm really glad to hear that. And I want to second what Barbara was saying. We really appreciate you and your team and the work that you did to turn this around. And the last general question, and then I'll yield the floor back. I know from working with you previously that, the work of the audit is primarily focused on the accuracy of the reporting. But that said, you deal with a lot of organizations, and I was just curious if in the course of looking over our statements, in terms of the actual numbers that you were seeing, were there were there any surprises or areas of concern or things that jumped out that although they might be accurate from a reporting perspective, may have raised some questions about, the underlying financial health of the organization?
That's a really good question. Starting with the bigger picture, the overall health of the organization, no, you're looking very healthy, and that's kind of what that one overview slide is meant to cover, is just kind of a big picture. Where are you at right now? And overall, I think the library is very healthy. Obviously, management has better insight than we do, but I think you'd find anybody hard pressed to say that you're not in good financial health. As far as items that surprised me, I want to be clear, this is not something that surprises me, but just something that I think is interesting to note and might be something that could cause a question for the public. And it's the fact that all the other funds within the fund financial statements had a positive change to the fund balance, with the exception of the Measure Y fund. And if you look back in the back of the financial statements at the supplemental information, there actually is a schedule of budget to actual, which a more experienced reader would understand that the Measure Y funds are there to be used. They're there to be spent for all of those purposes that we discussed. And you could see that you were actually budgeted as approved by this commission for a larger deficit in spending than you actually ended up at. But just that one fact that you have just one fund that was negative, I think could cause a lay person or somebody not familiar with government accounting to maybe kind of, question that or kind of raise an eyebrow. But it's not surprising to me, but I get to just be something that I would point out to this commission to keep in mind for people that are less sophisticated.
Good. Thank you very much. I'm sure there are other questions, but I just want to let you know how much I appreciate your work on this, Kellen. Thanks.
If I may add to that, Kellen is absolutely correct, and I believe that the Finance Committee that really monitors our finances closely. The reason why, and I'm stating this for the benefit of the public, is that in Measure Y, or the sales tax, there is a use, or technically a deficit spending, is because we use fund balance to pay for our capital projects. That's primarily the reason why we do that.
Thank you. Excellent points. Deborah or David?
No overall, no.
Okay. I'd like to ask a few questions. On page, should we use your page numbers or ours? I think it's page 4 of the draft, page 13 of our agenda. And page 14. So we talk about, fund accounting, and we basically have two funds. We have the property tax, which we're using the term general fund, but it's really the property tax. Is that correct? Are they equivalent? In your mind?
It is it's a little bit more complicated than that. You're absolutely right that the general fund does capture the property taxes, but the general fund is really kind of the key to any government organization. Right. It's really designed to kind of be the catch-all for all the operations within the library. So yes, it is the property tax fund, but it's really, I kind of think of it more not on the revenue side, but more on the expenditure side, that it's really the administration fund and also the fund that collects all the expenditures that don't fit within one of the other two fund line items, the Measure Y or the other funds.
Right. So it's helpful to think of Measure Y as a very distinct fund, and everything else is in the general fund, most of which, as you say, in the On the revenue side or the expenditure side? It's mostly property tax.
Yeah, on the revenue side, it's the
Okay.
property taxes, yes.
Okay, so on the middle of the page on financial highlights on page 4 of the audit. Could you explain a little more detail? As of June 30th, the government funds reported combined ending fund balances of $47 million, which is an increase of almost 2 million. Of this amount, 29% of, or 13 million is available for spending at the library's discretion. And then the next line is the unrestricted fund balance, which is a term, we're more used to dealing with here on our reports, was 19 million. And this again talks about the general fund expenditures as opposed to breaking that out in between the Measure Y fund and the general fund.
Yeah, so that I think you can see where those numbers are coming from if you flip to page 15, which is the balance sheet, the governmental funds balance sheet.
Right, 15 of your page?
Yes,
Okay.
yes, exactly, 15 on my page.
Okay.
And that really has all the different categories of the fund balances. I'm sorry, 15 of my reports page, so about 9
Yeah.
more pages.
Yeah.
25 in your packet.
Yeah, right here, if you scroll down. So here you have all the different types of fund balance, and really when you're talking about restricted, that includes the committed fund balances as well, I believe, if our numbers are, I want to make sure I'm not saying anything incorrect, but off the top of my head, I believe that's the way it's being represented. And that's, again, that's all determined based off of how the GASB has these things categorized. But this is really where all the different fund balances reside. You've got your capital improvements, your major maintenance, and the stabilization fund. Those are what we consider committed. And then you have the largest number there in the Measure Y is the restricted. And that's really because when you have a special revenue fund, by definition, those funds are restricted for the purpose of that special revenue fund. So literally by definition, your excess fund balance is going to be restricted for the Measure Y. And so then you can see the 13.7 million is the unassigned fund balance in the general fund.
Well, when we come down to the bottom of that column there, right, you're talking about where it says unassigned, it doesn't break it out between the general fund and the Measure Y fund as we do in our monthly reports. And that's, I guess, what I get. I'm not clear about.
I think what Kellen was saying is that Measure Y is a special revenue fund, and according to the rules that they have to follow, the fact that it has some designated uses means that it's restricted. So whether we consider our Measure Y funds encumbered in any way or not, the fact that it's created for certain purposes makes it restricted. Am I hearing that correctly?
You said that so much more eloquently than I did. You absolutely nailed it. Yes, from your position of governance, those Measure Y funds are not restricted in how you would think of that there's some claim to those. But from the GASB reporting perspective, as a Measure Y, as a special revenue fund within the government funds, by definition, they have to be shown as restricted. But that doesn't mean that there's any encumbrance on those or any sort of designation internally.
That's great. Thank you both for clarifying that, and that helps. Okay. On your page 10, we're talking about the buildings and improvements and the $5 million, $5.8 million in the capital asset line there under buildings and improvements. is that largely the anticipated or the asset of the building itself of H&G Library? Oh, I know that there are other assets we're including, but just kind of how much that building is worth.
I believe so. I'd have to double check any of the specifics, but that sounds correct to me.
Okay, and then on down under the capital assets activity, it says building and improvements due to the completion of the Cloverdale refresh, which I don't think has been done, has it? It hasn't been done yet. So
Okay.
I don't know.
That's a great observation, and we can circle up with Myrna and the county and clean up any verbiage in this MD&A. If that hasn't been completed yet, then yeah, that's not supposed to be there.
Okay, and then it says study pods, not clear where the study pods go. IT over at Roanoke Park headquarters and the branch manager's office. So I don't know what branch manager that, it kind of jumps back and forth in that line.
So these items, the total is for the combined projects. The study pods are study pods that were installed at the different branches. And the IT area is this new IT moved from the main, I guess, lobby area that we have here at headquarters and moved over to what's behind this screen is where IT has new office space. And so that was an improvement here. And branch manager's offices, we had improvements at Sonoma as well at, and it may have included Roseland also.
Okay, so we need to make those, kind of corrections, I think, for clarity in that line there.
Yes, for Cloverdale, we'll take a look at that.
And also, I think, when you put study pods in various locations or in several locations, the the movement of the IT area, and then, whatever branch manager.
Okay,
or-
more
or
specifics.
fixed up.
Okay.
Okay. Excuse me for going through here at a snail's pace, but. On page 29, under cash and investments. The treasurer's pool. So it talks about, we invest, obviously most of our cash in the investment in the treasury pool, the county's treasury pool. But some of these that we don't. On note D on the opposite page there, it talks about petty cash, payroll clearing account, and cost recovery clearing. And cash restricted balances related flexible spending account and health reimbursement account. So if we don't invest those in the county treasury pool, where are they?
What note was that?
Page 29 at the bottom.
Okay. 29 of,
yeah, R30.
oh, 29.
Yeah, I don't have the specific name of the financial institutions on the top of my mind. I can certainly look those up for you, but I think that's probably a better question for management.
The library also holds funds at Bank of America for for processing our payroll, for processing some other benefits such as our FSA. I don't know what FSA stands for. Flexible spending. And so those are our primary accounts. We also hold account for various things that will come to the commission. For example, we're opening a new account in the near future to administer commuter benefits, as well as we have another account for capturing all of the little merchant fees, photocopiers, all the change that we get from the photocopiers, all the other fees that come through the branches are deposited at the Bank of America.
Well, I'm just wondering about another note, whether we should just add a note that these other funds are, either Bank of America or another, whatever, just for clarity. The one is really a large amount of money, $852,000, that I guess that kind of prompted my question, is it drawing any interest? I mean, is it? Whether it's-
Yeah. So the money invested in the treasury pool is actually, as soon as you deposit it, it basically gets prorated among all the monies collected by the county pool. It's a massive sum of funds, and they invest it, and then the library essentially gets allocated their proportionate share of any interest or the increase in the appreciation in those underlying investments. So the short answer is yes, the thought behind why most governments use a treasury pool is that you're able to invest in larger quantities when you pool it with other local governments. And theoretically, you should be getting a much more significant return on those funds versus just investing them on your own. So
Right.
that's, yeah, so there definitely is monies that are being made on those treasury funds. Again, just if you recall the years when everything was down, those monies took a loss just like anything else. But overall, if you look at the history of those funds, the pool does pretty well.
Well, yeah, I understand that. I think maybe I'm not reading this correctly, but under your note D on page 28, it says we pool all the cash except for petty cash, a clearing account, cost recovery, and restricted cash balances related to the flexible spending account and health reimbursement account. So that reads to me like those aren't in the pool accounts. And so if they're not.
Yeah, correct. Those are all in the B of A. Yes, those are all not in the pool. That's all in different. I think there's multiple different B of A accounts.
Right. So it's a really large amount of money in the health reimbursement account, 852,000.
That's correct.
So that's in a more of a savings, interest earning account. I just find it kind of confusing because the title is investment in the treasury pool. And then these amounts of money are separate, but we don't really know where they are in their.
Okay, we could clarify.
Put a note in there. Great. Thank you.
Yeah, I typically don't say the name of the financial institution, but we could certainly say, amounts not pooled in the investment are kept in with a financial institution.
That would be great. Page 44 of the audit report. Under long-term obligations. Says in November 2020, the library entered into an agreement to finance the acquisition of equipment. It seemed like that was a little general for what we were trying to say. Do you know what kind of equipment that was?
This is photocopiers that we have leases with, and primarily.
Okay, so maybe just some clarity about that. It's kind of a general word. All right. I did see on page 45, the amount that we were paying the county of Sonoma for services was actually significantly more than I realized. So they're doing some pretty significant accounting for us. It's like $377,000.
Page, what was that?
Page 45 of the audit report. I was just a little surprised by that amount. The related party transactions. Or some of it's for fuel. Yeah.
It's for project management.
This is a combination of all the services that we pay for. The most expensive is two most expensive that total approximately $300,000 is the use of their financial ERP, their financial system. And the other is accounting services that we used in preparation for accounting. And not only the use of the ERP, but they charge us by per transaction. Each invoice that we process, they charge us, so that's well over $100,000.
And that's something they have done for us ever since we became an independent JPA. I mean, we've never done those. that level of
Yes,
transaction.
annually, they submit to all the special districts that they provide this service for, a schedule of what it will cost us in the next fiscal year.
All right, thank you for that.
Just a note,
Yes.
as I recall a few years ago, and it may have been before you arrived, Myrna, we had some discussion about whether we should take back, or we should create our own financial services department and not work with the county, but decided not to.
A lot, so there's a lot more going on than bringing it down. And Kellen, I just have one more question. Then reading the letter on pages, oops, they're not numbered. Oh. It's
The compliance report?
independence. Yeah, the independent auditors report. It's really interesting that, I don't know, it feels like, I thought in your initial remarks, you were talking about providing an opinion. And then the way this kind of reads is that, we don't state an opinion. In the middle of section page 55, report on compliance and other matters. However, providing an opinion on compliance with these provisions is not part of our objective, and we do not express an opinion. The results of our test disclose no instance of non-compliance other than matters are required to be reported under government accounting. Is this the level of auditing that is appropriate to a public agency? And it's appropriate for us to not ask for your opinion on those matters? I'm assuming the answer is yes. I'm just kind of asking a question from a devil's advocate standpoint.
Yes, yeah, great question. Yes, this is the boilerplate language. So literally, I don't have any ability to modify this report for legal reasons. So this is the standard verbiage that is used when there isn't compliance. So I want to be clear. We consider internal controls for our planning. There may be sections where we choose to test internal controls to help expedite the audit process, but we're not required to, and we don't specifically test all of the library's internal controls. So we're required to note if we do observe a material weakness or significant deficiency in internal controls, but we don't specifically test those items. So when I say that we provide our opinion on whether or not the financial statements are free of material misstatement, that's really referring to the first audit opinion. And then you're correct, we don't actually issue an opinion in this compliance report. We essentially just note that we didn't identify any of these type of issues. But you're absolutely right. We are not providing an opinion, a blanket opinion on whether or not your internal controls are free of material. It's not that, wouldn't be that verbiage. It would be, whether or not your internal controls are functioning 100% as intended. That's not the design of our audit, and that would be much more time consuming and costly to actually perform a internal control audit, and that's not what we're engaged to do.
So I guess I can't ask you for your opinion on this, but just to give us all, I don't have any doubts or anything, but this meets the level that we should be meeting in terms of the design of the audit for independent public agency.
Absolutely. And this is still considered a clean opinion in accordance with government auditing standards, even without specific verbiage saying we're providing our opinion on internal controls. This is just the the way that it's designed, and yes, you've met all of your requirements under government auditing standards. There's no requirement that you have your internal controls specifically audited.
Great. Well, anyone else on the committee have any additional questions, Andy?
Yeah, I have a couple. First is a kind of a minor point, and the second is, I think, a more substantive question. The minor point, and this is on page 12, under the paragraph economic factors and New Year's budget. The first three sentences seem perfectly clear. For fiscal year 24-25, the two major revenue sources are property and sales tax. Property tax revenue is expected to increase due to increased home values. Sales tax is expected to decrease due to a decrease in consumer spending on goods. That's fine. What follows are two sentence fragments that I think something was left out. A decrease to the operating expenditures budgets for supplies, both physical and electronic materials, period. Increased salaries and employee benefits due to increases in benefit costs, outreach and programming, period. So I think we need a little edit there to provide some additional clarity.
Okay.
You see the paragraph there? Yeah.
Yeah.
And then the more substantive issue, and I think this is really more for management, but this is to me on page 7 of the audit report. It's page 16 of our packet, Lisa. Yeah. So the last two bullets, the first one, personnel expenses increased by $6 million to $30 million. I'm just going to pause there. That's an increase of 25%. That's a substantial increase. And what follows is not, to my way of thinking, a reasonable explanation. It says the increase can be attributed to an increase of 2.1 million in salaries and benefits due to the addition of 4.5 FTE and 2 vacant positions filled. Well, if we divide 2.1 million by 6.5, that's $356,000 per position. That's clearly not reasonable on the face of it. And that still leaves a $4 million gap, which is explained to me in a pretty vague way when we say actual and expected experience regarding employee retirements and investment performance. I think given the significant increase, this could use a more detailed explanation. And I feel the same way about the next bullet. It says the library's program expenses, well, actually, not as much in the second case. Second case is, it's what, 70, it's 20% increase. It's substantial, but it's not as much as the first one. I think the first one is the one that I would be most concerned about. Bringing some clarity.
Second bullet point, last year, fiscal year 24 was the first year that we had Sunday hours for the entire fiscal year. That was part of it. Also, there's always the increase of the COLA. And then you add the additional full-time equivalent positions. So those are, and then there was an increase in pension costs as well.
So the Sunday hours, I think, would be very important to mention there if that was a significant contributing factor.
Yeah. In terms of the personnel expenses, again, there was an increase in pension costs, as well as the full year of Sunday hours and the additional 4.5 in positions. And we're essentially fully hired. So last fiscal year, we hired a deputy. We hired basically 2 management positions. We hired a deputy director and we hired an accounting manager. Those are significant increases compared to the prior year, in addition to the pension costs and the Sunday hours.
Well. No, I agree with you, and I had that circled, and I forgot to say anything. But I think adding that those additional pieces of information, certainly the cost of living increases and the Sunday hours and the 2 management positions, I think all that information really, it's a very legitimate question to ask, is it is a large increase.
Would that also be that we added community engagement? Would that be in that cost or not?
So I can't hear you,
Yeah.
Dara.
Okay, we also added the community engagement department, which, you know, came with at least
that's
2
three
full-time
managers.
positions, another manager and another full-time position.
So are you saying that you added more than 6.5 FTE?
No, the FTE is correct. We had the new full, I don't want to confuse this.
You don't
We-
need
we
to
hi-
solve this.
We hired 3 new managers, right, which are the most expensive in the library. A deputy, an accounting manager, and a division manager. In addition to that, we filled a position within the new community engagement division. So those are I can't give you an exact number of what that is, but that including the increased costs of the COLAs and our step increases, all of those add up. And if you want to break down, we can provide that.
Well, I think it's important to include all the factors because the way it reads now, we added 4.5 FTE, we filled 2 vacant positions, and those 6.5 people cost us over $2 million. That's not accurate, and it's going to raise red flags among people who feel that the library is not responsible with our salaries and compensation.
Well, we'll be clear that we have pension costs and our COLAs and
Okay.
medical costs, et cetera.
And Sunday hours.
And Sunday
And
hours.
Sunday hours, I
Yeah.
think that Sunday hours belongs in both of those.
Right, so all the clarity you can add to that.
Thank you.
Yeah, thank you. Thanks for bringing that up, Andy. It's a good point. And any other questions? About to wrap it up. So Kellen, you mentioned you're 90% through with this before presenting to the commission. Anything you're concerned about in the last 10% or anything holding up the last 10% or anything you'd like to tell us about whatever that is?
No, sorry, I think I said 95 to 99%. So essentially just wanting to make sure that there weren't any, I appreciate this committee who is always watching everything so closely. And so just making sure that there wasn't anything in this commission and making sure that that you approve the financial statements is one of our last step. And then just some crossing the T's and dotting the I's from our end that's required through the end of the actual audit. But it's not like we still have a major procedure to perform. We're just in the very, very last final stages, including this meeting.
Right. Well, thank you very much. You and your team very much appreciate it. And we look forward to seeing you at the commission.
Okay,
sometime soon.
we'll work with Myrna and the county to make these recommended changes.
Excellent. Thank you
Thank you so much.
Thank you.
Thank you.
Cheers. Happy holiday.
Thank you, Kellen and Sarah.
So I have a related question for our CFO. I didn't think I should ask Kellen this question. In terms of best practices, I was on the commission on the finance committee when we selected Bezeni and Brinker to be our they were our new auditors at that time, because the library commission before that had an independent person. I think it was a solo practice out in Sebastopol or something. Anyway, we went through this whole interview process and, the thought was it's good to change auditors periodically. And so now it's been a number of years since we've had Pacini Bringer. Now we're all clicking along smoothly. But is it a legitimate question to ask about, you know, looking at changing auditors, and when should we do that?
Apologize, I have to leave immediately to run. So I didn't want to be,
On the run. Thank you.
I didn't want to be ruder than I wanted to be. So
You're
probably-
full.
Thanks, Sarah.
Bye, thank you.
That's a very good question. We have an RFP plan for this, to let out this fiscal year.
Okay.
So that doesn't necessarily mean that we will change. It depends on who responds to that RFP and what those costs are, and then the decision, the selection that needs to be made.
I was gonna ask the same question.
Okay, David, you're.
Yeah, I'm not comfortable with staying with the same auditor regardless if they get, you know, make the best presentation to people who have collected resumes essentially. I have no reason to believe that these folks are not great. It's just that, well, what is the professional best practice here? Could we have the same firm for 20 years?
There are best practices on letting out an RFP. The RFP itself lays out transparently what the criteria are for selections, what are we looking for in an auditor, and then we look at the most responsive bid, and we go from there. And we have no control as to who decides to respond or not.
Well, could we impose a hard limit of 10 years?
Oh,
Saying,
yes,
That's my concerns. So far, I haven't heard anything about that.
Oh, in terms of, yes, you can all, in the RFP, you also say, this contract is for 3 years. And then before the 3 years are over, you let out another RFP and do another competitive process.
But if the same person always gets the bid, that doesn't make me that happy about independence, fresh eyes on the institution and so on.
Point well taken.
I don't know where to
When we
go
let
with
the RFP out,
It's like a
and we
policy.
give you, we have to, the commission is the one that approves the contract. We lay out what the process was, exactly who bid, how much they bid for, and what the final selection was. It's the same kind of process that you have seen with the refreshes.
So I think I made my point, but I'm not happy with the giving the same firm, because there's very high level professional work here. It's not like building a
But I
refresh.
understand.
Okay, that's all.
We want to also select all of this process also includes qualifications, experience with government auditing, et cetera. I understand what you're saying, Commissioner Cahill, and we'll do our best to select the best. We don't know who's going to apply, and we'll go from there. We can't really dictate that we're going to change if maybe Pacini and Bricker may not apply. And we just don't know. It may be others that apply. And then we have to question, are they really qualified and meet all the qualifications? If they don't, we have to scratch that RFP and then reissue a new one until we do find someone that, some auditor that has the qualifications to conduct an audit.
Part of best practices is getting the best auditor. And so, yeah, just change for change's sake, but I agree. I mean, that's why I brought the question up.
Yeah, that's the whole purpose
Yeah.
of the RFP, is to give different vendors an opportunity to bid.
Can I just ask a question? So Dave, what I think I'm hearing you say, I just want to clarify, is understand there's going to be a competitive RFP. You know, my impression of Pacini and Brinker is that they're very professional. They've been responsive. They've done a great job. What I think I'm hearing you say is regardless of that, you do not feel comfortable continuing longer than X years with the same firm,
Yes.
even if they were the best qualified and lowest price that we got in the RFP, at some point, you're gonna feel like we need to change, or you're not gonna be comfortable. Is that right?
Yes,
Yeah.
because we could be developing a sweetheart relationship with this.
Okay,
I think is a bad idea.
I'm not disagreeing,
But. good thing for us all to keep-
And just one last note, things have changed dramatically in terms of how the finance staff handles our finances. And so I think that, Paccetti and Becker was doing specific things in the beginning, and the relationship has changed, I think. So we can talk about that when we talk about, but I agree that it's a really good thing to look at.
Agreement. I am a little bit concerned about the timing, so maybe we can go through, with some liberation, please, speedy approach to 4.3, our monthly report. Objection, yeah, fair enough. Okay. Highlight on.
Do you really have to say anything?
Well, the only thing I will say about this is that the October report, as you know, the next item is a report on a revenue shortfall under sales tax fund. And the October report does not reflect any of those budget changes. I just wanted to make sure that, make that point. Other than that, I think that, our property tax, we will be seeing, the first installment, next month. So I'm happy about that. And then we could move into the next item if you like. Catherine, did you want to say any highlights here?
Thank you. I think you summed it up really well.
Right, well, if Andy was always reminding us, the percentages were 1/3 through the year. This is 4 months worth of report, so always good to use that as a eyeball for the appropriate expenditure amounts. Andy, did you?
Can I say just one thing? Because I agree that we can move off of this. I was, and this is, I think, a segue to the next item. I'm very concerned about the sales tax figures that I'm seeing here. We have 2 months of sales tax. And I know that in the next item, we're going to consider an expected reduction in the sales tax revenue. This report makes me feel like the reduction in the sales tax revenue is going to be significantly more than what is discussed in the next item. And I'll just do this quickly. I'm on the, yeah. I went back to the previous year and said, okay, how did the first 2 months of last year compare with the total of last year? Was it basically a straight line? Was it 1/6 of the total revenue? And actually, it was slightly more than a sixth. It was 17.14% of the total, and a sixth would have been 16.66. So if we look at what our year to date is and multiply that by 6, we certainly don't get 16.8 million, which is what's budgeted. We don't get 15 point whatever million we consider in the next item. We get 14.24 million. So there's a significant sales tax gap. And I just want us to be aware of that as we go into the next item.
Thank you for that.
Point well taken. We are addressing a revenue shortfall, and I did address, additional comment, response to Commissioner Elkins, observation in the next item.
Jump right into the.
Okay, so I have some, a PowerPoint, very brief PowerPoint that I'd like to share with you.
Ooh, the laser point.
Okay. So I wanted to give you, just some slides to put all of this into context. So we're looking at proposed budget adjustments to close a revenue shortfall, under the sales tax and the fiscal impact on fiscal year 24-25. Okay, great. What I have here is that, at the September 13th Finance Committee, I presented a high-level overview on the sales tax revenue shortfall. And it presented some preliminary strategies to close the shortfall under sales tax. The good news is that since then, I have received property tax update based on certified property values for this fiscal year. And it was good news that it's projected to be $399,000 greater than the adopted budget that I'm proposing to help offset the reduction on the sales tax side. But there were two factors that prompted the need to revise the sales tax revenues. And again, now I'm going back to September, or even prior to the last fiscal year. This committee was aware that there would be a shortfall in sales tax. But we would not know what that actual shortfall would be until August, when we received the last installment for the fiscal year. So there was that piece. And then we also knew that other revenue, primarily the interest earned on our cash balances, was performing better than expected. So those two items, that particular item helped offset the revenue shortfall. In addition, our expenditures were less than budgeted, so that helped the situation. However, but on the revenue side, we were short last year we were short $863,879. But we didn't know this until August, and the budget was developed for this year, was developed in February, presented to you at the budget workshop, and then adopted in early June. And so we came in, I had the projections for this year I have a base, and the base is assuming that we had met our target for last year. And since we were short over $800,000, then I have to recalculate the sales tax revenue for this year. In addition, the county used 1% essentially growth rate, while our adopted budget assumed a 2% growth rate. So now we have a shortfall in the revenue and a lower growth rate. With those two factors combined, the updated sales tax revenue projection gives us a shortfall of about $1 million. compare that with our expenditures, without changing any expenditures or making any adjustments, our shortfall is $976,000. So,
Can I jump in for a
Yeah.
second? The reason for that, which was not entirely clear, is that we had a small surplus
yes,
in the budget of like $73,000. And so that surplus in the sales tax revenue and expenses kind of goes away. And when you take that away, it reduces the shortfall from $1,050,000 to 976.
that's correct.
Right, okay.
And so here's the graph to illustrate that shortfall. Okay, there we go. So moving on to the next slide. Here you have this chart in your in your packet, and here is the overall picture of property tax and sales tax combined. And sales tax is projected to decrease to $15.7 million. And the strategies to close the gap are to increase so I'm just going to talk about sales tax first. To increase other revenues, essentially the interest earned on our cash balances by 100,000. We originally had 131,000, and I'm proposing to increase that to 231,000. The good news is that we're already very close to making that if you saw the October report.
Can I ask a quick question? I don't mean to be a pain. Is that interest earned on funds that were collected from sales tax? I guess my question is, why is interest earned? Why does that go into the sales tax column? Is it because we're segregating monies collected from sales tax and monies collected from property tax, and this is only the interest on the, okay.
Yes, government funding, as we talked about in the audit, we have to separate in one fund. 74805 is the property tax, 74807 is the sales tax, and we need to keep them separate. And when the interest earned on the pooled cash, it's prorated according to your balance.
Okay, so even though we're in this report, it's combined, in fact, you're breaking out. We're not, my concern was I didn't want to be saying that money that was not legitimately sales tax was going into the sales tax fund, that's all.
The interest earned on the sales tax balance is booked to the sales tax fund.
Perfect, thank you.
So here you have the $1 million shortfall with an increase in sales tax revenue of 399,000. So a net decrease overall in revenue of 550,000. On the expenditure side, I am reducing the contingency fund under sales tax by 100,000. So if you could see, it was by 200,000 or 100, actually 191,000. Yes. So the adopted budget had 314,000. I'm proposing to use 191,000 of that. So, but also on the property tax, I'm increasing it. Also under sales tax, I'm also reducing services and supplies. More detail is in those individual sheets that I give you in attachment B. So we could go in, we could go in there to see that. If you have any questions here, I'd rather go into the more detailed sheets for you.
I'm sorry, I'm gonna back you up to a much more general thing, and I apologize, because I found this really confusing. So I'm gonna try to take a simple-minded approach, and I want you to tell me why it's not appropriate, okay? We start out, and I'm gonna come back for the moment, for the purpose of our discussion. I'm gonna say, yeah, let's use the new projected sales tax revenue. As I mentioned earlier, I'm not sure that's a good idea. I think the actual sales tax revenue is going to be significantly less. And I think we should have a discussion about, do we want to be going through this exercise again in a couple of months? Or do we want to bite the bullet and say, you know what, we need to, take a harder look at this. But for the moment, I'll put that aside. I'm just going to start with the projected sales tax figure that you gave. And that's a shortfall of $1,050,000. And then I'm going to start taking away things that would reduce that gap. So the first thing is, okay, we had a budget surplus of $73,000. That's going to go away. We're not going to have a surplus in the sales tax portion of the budget, but that reduces our shortfall down to $976,000. Then you were saying appropriately, you know what, our interest revenue is going to be higher than expected. We can reasonably count on $100,000 more in interest revenue. So that's going to reduce the difference from 976,000 to 876,000. Then you said, our property taxes are going to be $399,000 more than we expected. That's going to reduce that gap even further. We're going to have to do some shifting between monies that we allocate to property tax and sales tax. But in terms of closing the gap, that's going to reduce it by almost $400,000. And you've also reduced the contingency fund by $191,000. So when I look at those two things together, we say, okay, we're eliminating the budget surplus. We're increasing the interest revenue. We're increasing the property tax revenue. We're reducing the contingency fund. The gap is only $285,000. But that's like impossible to see here. It's really.
Okay, well, that's why I'd like to go to, this is combined so that let's go to attachment B. Oh, no. You know what? Let's just go to attachment B in the document.
I'm gonna just step in here for a sec. I actually did understand I felt like I understood, a rationale and whatever. And for my own personal safety, I'm gonna have to leave you pretty soon because it's getting dark. So the meeting we're gonna stay, but I'll just stay for a few more minutes if that's, sorry about that, but I just, I don't like to drive after dark. So go ahead and I'll leave.
Okay, so we can start here with this, this sheet here. And you can see that under sales tax, I did need to make up $876,000 under sales tax. And the way we could do that was we gave direction to divisions that they could reduce extra help and services and supplies. So we applied, in order to meet that target, we applied a 19% reduction across the board to each and every account. And except for under collections, we did not apply the 19% to books and materials to the collections division. So the total was reducing extra help by $54,000 under public services with the closure of 2 branches. We thought that it would be feasible with very, very minimal impact to public services. But in order to conserve public services, we did reduce primarily under services and supplies for a total of $685,000 and a reduction of the contingency fund of $191,000 for a total of $876,000. That's gross. However, with the $399,000 under property tax that we can use, we offset certain, we added back funds under certain accounts that under budget and finance, they included the cost of running our financial system. For example, under executive services, I added back funds for our leases and our legal services for a total of $19,000. Under human resources, also there is legal services there, so I added that back to make it whole. Under marketing, no, I'm sorry, marketing did not add back. Technology, there are contracts there for maintenance and other contracts that we are obligated to pay. So I added back funds of $93,000 to cover those. Under facilities, I added back any cuts and made whole the utilities, water, electricity, as well as the security services contract. Added back $103,000. So there's a net savings cost or reductions that you can see here for a total of $456,000. So this $876,000 is a gross reduction plus the benefit, the use of $328,000. I'm not using the $399,000 because I'm only adding back $100,000 property tax to the contingency fund. So these numbers here are what match that attachment A.
So there's going to be another $71,000 in property tax that would just be surplus.
Yes.
And presumably what you've done in the past with the 60-40 expense allocation it's going to be shifted a little bit based on the fact that you're picking up some additional expenses from property tax.
So yes, so then what I did, I used these figures and can move to the next page. The ratios that were in the adopted budget of 60%, for example, 60 under the service-oriented divisions, 60% of expenditures are applied to property tax and 40% to sales tax. Those are now revised given that we're making adjustments here. So under the service-oriented, this was the adopted budget, 60-40. It is now going to be 65-35. But it's only under services and supplies. It's still going to be a 60-40 under salaries and benefits. The other change is under administrative. The adopted budget has a split of 90% property tax, 10% sales tax. The revised is 92% property tax, 8% sales tax.
So that works great. And I can see that there's a ton of work behind this. I guess my question is, that works great if we assume that the shortfall is only what we assumed it to be and not what it looks like it's going to be. So my question is, how do you feel about that?
Well, there's a big caveat and a big acknowledgement that this may not be the last cut that we need to experience. And this is what I've been telling the division managers. This exercise alone makes everyone uncomfortable. And I've made aware that maybe even this year during mid-year that we might need to see additional cuts, because I don't know. Normally there's a spike in sales tax in February, but February reflects the December expenditures, holiday shopping, etc. So although I completely understand where Commissioner Elkin comes in and I've looked at those numbers as well. This $1 million shortfall takes us back 2 fiscal years. Our actual revenues, less than 2 fiscal years ago. And so yes, do I lose sleep over it? Yes.
So let me just ask you 2 things. I guess my first question is, how much work is required to do this? Seems like a lot.
Mhm.
And then my question is, how many months from now do you feel like it will be appropriate to look again at the revenue, gulp hard, and go through this exercise again?
Well, so far we have, through October, that's 4 months.
But only 2 months of sales tax.
Right, but remember, if you don't have the details of the sales tax for October, but the revenues for the pooled cash, the interest we're already very close to making, the whatever my new adjustment is, the 300. So, or 2. So anyway, we still have that could benefit us, is to, if our cash balances and the markets are still performing well, we could get greater interest revenue than budgeted. And number 2, if we are very good at meeting these cost savings that really reflect how we spent funds last year, then if we do a little better in the expenditure side, where we can, for example, there's strategies that I point out in the report, is that there are efficiencies that the library system-wide can take on to gain some savings. In addition, there are opportunities for sponsorships where, if for programs, for example, and special programs that could help us offset any additional revenue loss. So those are strategies that we're implementing going forward that are already in play to help us offset any future shortfalls. I think that come end of January, I will be doing 2 major things. One is looking at the current fiscal year, if we need to make any further adjustments, right? Number 1. And number 2, what does next year look like? Because I have also mentioned to management here, as well as the finance committee, is that firms that study sales tax across the board in California, they're estimating a 1% growth if we're fortunate, meaning that we may not experience any growth, is the way I see it. 1% is very little, and we could even experience a loss. We just don't know at this juncture right now. And given that we're going through this exercise, I'm preparing individuals that we might have to do this again. What are our options at that point if we need to make deeper cuts? We do have a fund balance that, we could use, the fund balance policy allows for the use of fund balance. We're not using fund balance in my recommendation here because I feel that we can absorb these costs with very minimal impact. But I think any further costs would have an impact to services.
What I'm kind of hearing and reading into what you're saying is you'd like the commission in December to vote to approve these changes to the budget. You'll revisit this in January.
End of
if-
January, right?
and depending on what's happening with, maybe property tax revenue comes in even higher than expected. Maybe sales tax starts to increase. Maybe our interest revenue is higher than anticipated. Or maybe there are other savings that are found, but you would look at this again and see if we have to go through this exercise again, then.
Yes,
If I could jump in here and seize the floor. So your intent is to bring this to the commission for its action on December 6th, right?
yes.
Is it practical? I share a lot of what Andy has found here. I think it's a confusing set of corrections, each one of which makes sense. I'm not sure that anything we've got in writing explains to non-finance committee members of the commission exactly what the steps are. And I'm missing what I would call where the rubber hits the road list. What is actually going to change in the various divisions. I don't think I missed that in your memo. I didn't see anything saying this is what it means. I think that's probably the most important thing. Would it be practical for you to write a memo to the finance committee within the next week or so, sort of fleshing this out, or is that too much to ask?
What I could do is, I could include additional narrative, on the impact, for the commission. That this needs to go to I would like for this to go to the commission in December for a vote. At this time, like I said, our division managers are not taking this very lightly. It is challenging for anyone to reduce your budget. But given where we are in terms of closing 2 branches and on the extra help side, and this is system-wide, that we feel that these savings can be absorbed. And it's just, we'll do our best to give you a narrative to share what the impact is.
Okay, thanks. Does anybody on the committee object to Ernest going ahead and putting this on the December commission?
No, not at all. And what I would offer, if you want, is that I could connect with you offline this week and talk through how you might present this a little bit differently to the full commission. You don't have to do that, but I'm offering that. But no, I think you have to bring it to the full commission in December, especially if we're going to be revisiting it, before the end of January.
Okay, so Lisa, could you call up the master agenda? I confess I was not expecting to be presiding, to cover everything or decide to postpone until our next meeting. Okay, update on sales tax measures. Anything we did not cover?
I actually have all the figures on that, Dave, if you want to make it part of the meeting.
Oh, I see. Yes, Andy, please go ahead.
So I pulled this off of the Sonoma County Registrar of Voters results site. And this is as of Friday, November 15th. The next update will be tomorrow around 3 o'clock. So as of Friday, November 15th, there were still 22,932 unprocessed ballots. And an estimate of 1,994 challenged ballots. So that means to me, there's roughly 25,000 ballots still at play. Of those that were counted, we have yes votes from 149,879, no votes from 71,813. The yes votes represent 67.61%. We have an upside of 6,253 votes, which is a thin margin with 25,000 still to be counted. So hopefully tomorrow we'll have some good news.
I did some similar calculations. My big observation is there have been several updates. Each update, the percentage yes, not just the raw figures, percentage yes goes up slightly, which is good, but unexplainable in political terms. There's no reason that I can see that this is so. It's probably one of those tyrannies of small numbers things that happen. My conclusion is, I don't think we should make any public announcement until we get a final certified count by the registrar of voters. It's just my own personal.
Totally agree.
It's too risky. I mean, you do one bad batch and we're doomed. So, anyway. Comments from, I guess, the chair of the commission. Okay, all right, well, that completes our agenda. Any items for future committee meetings? Going once, going twice. Okay, then without further objection, we're adjourned.
Thank you.
Thank you for taking over, Dave.
It's